There is a pattern that repeats throughout history. Different countries, different decades, different technologies, but the pattern stays remarkably similar. People become optimistic, asset prices rise, confidence grows, risk starts to feel safe, and then eventually, conditions change. The strange thing is that most financial damage doesn't happen because people didn't know a downturn could occur. It happens because they assumed they would have more time to save, more time to invest, more time to prepare, more time to get serious about their finances. Then suddenly the environment changes. Credit becomes tighter, businesses become cautious, consumers spend less, markets become volatile, and people realize that preparation is most valuable right before they need it. If you've been watching the economy and wondering what practical steps matter most before the next downturn arrives, this video is for you. Not predictions, not fear, not sensational headlines, just 3 money moves that can improve your position regardless of when the next slowdown arrives. And if you're interested in understanding how wealth is built and protected through changing economic cycles, make sure to like this video, subscribe to the channel, and turn on notifications so you don't miss future insights. Now let's begin. The first money move is something that sounds boring, which is exactly why most people ignore it. Build a larger cash reserve than feels comfortable. This advice rarely becomes popular during good times. When markets are rising, cash feels inefficient. People look at cash and see money that's not growing. They compare it to stocks, real estate, or other investments, and they conclude that holding cash is a mistake. But that view often misses the true purpose of liquidity. Cash isn't there to maximize returns. Cash exists to maximize options. Think about what happens during difficult economic periods. Unexpected expenses appear. Jobs become less secure. Businesses experience slower growth. Investment opportunities emerge. People who lack liquidity are often forced into decisions. People who have liquidity can choose. That distinction becomes extremely important. The strongest financial position is not necessarily the one producing the highest return today. It's often the one providing the greatest flexibility tomorrow. History repeatedly shows that downturns reward preparation. Not prediction, preparation. Many people spend years trying to forecast exactly when a recession will arrive. Yet very few spend the same amount of energy preparing for one. A larger emergency reserve may not feel exciting, but when uncertainty rises, it can become one of the most valuable assets you own. The second money move is reducing dependency on a single source of income. This is one of the most underestimated risks in personal finance. Many individuals believe they are diversified because they own different investments. But then nearly all of their income comes from one place, one employer, one client, one business segment, one economic driver. When conditions are favorable, concentration often appears efficient. When conditions change, concentration can become dangerous. Imagine a bridge supported by only one pillar. As long as that pillar remains strong, everything appears stable. But what happens if pressure is applied to that single point? The entire structure becomes vulnerable. The same principle applies to income. Economic downturns tend to expose dependencies that previously seemed invisible. The objective isn't necessarily to quit your job. The objective is resilience. Resilience can come from many places: developing valuable skills, creating a side income stream, building a small business, generating investment income, expanding professional relationships. The exact strategy matters less than the principle. The principle is reducing fragility. Because financial strength is not measured by how much money you make when conditions are ideal. It's measured by how well you perform when conditions become difficult. This idea connects to a larger lesson that appears repeatedly throughout economic history. Systems that survive are often not the strongest. They're the most adaptable. The same is true financially. Adaptability creates durability, and durability creates opportunity. Which brings us to the third money move. Focus on acquiring quality assets while avoiding emotional decisions. Most investors believe their biggest challenge is finding opportunities. Often their biggest challenge is controlling emotions. During periods of prosperity, optimism becomes contagious. People begin believing current trends will continue indefinitely. Risk appears smaller than it really is. Then conditions reverse, and suddenly fear becomes just as contagious. The same people who were eager to buy at high prices become afraid to buy at lower prices. Human psychology rarely changes. That's why market cycles continue repeating. One of the most important financial advantages you can develop is the ability to think independently. Not emotionally, not socially, independently. When evaluating investments, ask yourself a simple question. Would you still want to own this asset if headlines disappeared for a month? Would you still believe in its long-term value? Would you still understand why you own it? If the answer is yes, short-term volatility becomes easier to tolerate. The objective isn't perfection. The objective is discipline. Disciplined investors understand something important. Price and value are not always the same thing. Sometimes prices rise faster than value. Sometimes prices fall below value. Those moments create opportunities, but only for people prepared to recognize them. This is where the first two money moves become powerful. Cash reserves create flexibility. Multiple income streams create stability. Together, they position you to act rationally while others react emotionally. And that combination can dramatically change long-term outcomes. Now I want to share a perspective that many people overlook. Downturns are uncomfortable. No one enjoys uncertainty. No one enjoys volatility. No one enjoys seeing markets decline. But downturns also serve a purpose. They reveal weaknesses. They expose excesses. They reset expectations. And they often create opportunities that were unavailable during periods of optimism. Some of the most successful investments in history were made during times when confidence was low. Not because investors enjoyed uncertainty, but because they understood cycles. They understood that conditions eventually change. And they prepared before everyone else recognized the need. This doesn't mean taking reckless risks. It means remaining financially strong enough to take intelligent risks when opportunities appear. That distinction matters. Because wealth is rarely built through constant activity. More often, it's built through patience, preparation, and discipline. As we look ahead, nobody knows exactly when the next downturn will arrive. Anyone claiming certainty should be viewed carefully. The future is inherently uncertain, but uncertainty doesn't prevent preparation. In fact, uncertainty is the reason preparation matters. The goal is not predicting the future. The goal is positioning yourself so that multiple futures work in your favor. If conditions remain strong, you'll benefit. If conditions weaken, you'll be prepared. That's a powerful place to be. So let's recap the three money moves. First, strengthen your cash reserves and improve liquidity. Second, reduce dependence on a single income source. Third, focus on quality assets and avoid emotional decision-making. These ideas may sound simple, but simple does not mean easy. The challenge isn't understanding them. The challenge is applying them consistently while everyone else becomes distracted by short-term noise. Remember this, financial success isn't determined by what happens in the economy. It's determined by how you respond to what happens in the economy. And the best responses are usually prepared long before they're needed. If you found value in this video, take a moment to like the video, subscribe to the channel, and share it with someone who is serious about building long-term financial resilience. Thank you for watching, and I'll see you in the next video.